welcome to another run through of the top 5 charts of the week. And just before we get started, once again a reminder, if you haven't read it already, the top down charts turned 2 years old a couple of weeks ago. So if you want to hear some of my reflections of the first 2 years in business, you can have a look at that link there. Maybe I'll do a video on it at some point. Anyway, we'll get straight into it. First one is DM, or Developed Markets, PMI, Purchasing Managers Index. It's the manufacturing one, versus US 10-year bond yields. And just to be clear on the DM composite PMI here, so this is US, Europe and Japan, i.e. all those who release a flash or preliminary PMI reading, which we've already had for September. And so that's what we get, about 1 to 2 weeks before the end of the month, so it kind of gives you an early read on it. Anyway, what we've got here is, well, first of all, before we look at what it's telling us right now, we'll really have a look at what it told us earlier, or how we used it earlier. Actually, probably more interesting is, when I first started looking at this chart was in sort of middle of 2016 here, when you had this move up in the PMI against a move down, and then sort of a staying down of the bond yield, and you had that really interesting divergence going on. You also had it to some extent throughout 2017, where arguably the PMI was pointing to higher yields than what the market was sort of thinking is appropriate. But now we've actually gone in the opposite direction. So while that was quite useful then in picking the upside, now we've actually gone in the opposite direction, where the 10-year bond yields has actually moved up beyond where the PMI sort of says it should be. And so there's a couple of ways that we can think about that. The first one would be that the bond market's right and that the PMI is wrong, that this dip down in the PMI here is all about sentiment and news rather than actual activity. Because if you think about 10-year bond yield, typically trades on the growth inflation outlook. And one thing that would add weight to that would be that sort of 2013 period there, where bond yields headed up and then the PMI followed. So I think that, that's probably my base case, to be honest. But then, if you were to use it in the same way that we used it throughout this period, you'd be saying that this recent rally this recent move higher in bond yields is actually counter or contrary to what we're seeing in the PMI. But this little tick up here that we've seen in the most latest reading is quite promising, particularly what we're seeing in the US and Japan PMIs. So I wouldn't count the global economy out, certainly not just yet. And on to the next one, number 2, global consumer sentiment. So this here in the light blue line is global consumer sentiment, and we've calculated that based on world GDP weights, and it's using the Thomson Reuters Ipsos Consumer Sentiment Index. It's a one that Thomson Reuters calculates in conjunction with IPSOS, and they calculate it on a standardized basis across a bunch of different countries, so it sort of helps. In that sense, we can produce a kind of global view of consumer sentiment. The downside is that it only goes back, as you can see down there, to 2010, but we have got at least 8 years, almost 8 years of history there now. So, but what's it telling us? The latest reading did dip down a little bit. It is a fairly volatile index, in the scheme of things. If you look back there, you can definitely see the trend, but throughout that trend there's been lots of chopping and changing around. But I would say my interpretation would be that the overall trend, and certainly the level, is still pretty decent. And the other interesting thing is how it has diverged from the path of the global manufacturing PMI. So, consumers are still feeling pretty good, whereas manufacturers have been a little bit skeptical, and I think that goes back to that what I was saying in the previous chart, that there could be an element of just plain old sentiment and being scared by the news headlines that's pushing that down. So, but then the other thing is consumers tend to be more of a lagging or coincident indicator. I guess where we saw this in the past was in 2013 when the PMI surged, and then it took a while for the consumer to follow. But I'd say this kind of lends itself a bit to what I was saying before as well. Having a fairly constructive view on the outlook there, because if the consumer's doing good, then that's still a fairly key part of the economy. Number 3, long-term investor sentiment trends. So this is quite an interesting one. It's one of my old favourites actually. So in the red line here we've got bearish sentiment, which is a combination of the AAII and II investor sentiment surveys. In the blue and the green line we've got the bullish sentiment. So these are two sides of the same coin. And really the interesting thing about this is how in the 2015-16 corrections we saw a major shift in sentiment, major washout. But this little correction that we've had this year, well, little for the S&P 500, large for global markets, global equity markets at least, has the markets or sentiments really hardly even moved. And at the moment we're sitting at levels of bullishness which we hadn't seen since the start of the mid-2000s bull market and the end of the late 90s bull market. So it's kind of interesting, and it's interesting too how there's not really a reliable pattern here. But then the more that you think about, maybe there is a reliable pattern here, because you expect bullishness to rise at the early part, or the initial phase of a bull market, as a big reset sort of unwinds. You can see there in 2008 and in the early 2000s, and actually in the mid 90s, around 94, when that big old bull market there got underway. And you also see, so I guess you could call that correct optimism or correction in sentiment. But then the other kind would be the sort of incorrect or too much or unjustified optimism, which you'd see at the last stages of the dot-com bubble. And maybe you could argue just before 08 when you had that little tick back up, but particularly before the 2015-16 corrections, you actually had quite significant and, in hindsight, arguably unjustified extreme bullishness. So what is it now? Well, as the global economic cycle, particularly for the US, as the US economic cycle matures and monetary policy begins to tighten, you could definitely start to argue that this is unjustified or increasingly unjustified extreme bullishness. I mean, of course, it's going to be one of those things that you can only know in hindsight, but you look at this alongside high valuations as well, because usually at the start of these bull markets, you tend to see lower valuations. At this stage of the dot-com boom, valuations were very high. Back in the mid-90s, not high. At the start of the mid-2000s bull market, valuations were, well, they weren't that low, but they'd undergone a major reset. And the same thing in 08, they were, an unbelievable buying opportunity at that point. So it's definitely a background feature to be cognizant of, and I would think that as other elements come into play, it's going to be increasingly a market timing piece of information to be mindful of. Number 4, CRB Raw Industrials. So this is quite an interesting index. I think most people are aware of it by now, but if you're not, basically it's a basket of industrial commodities. So things like rubber, cotton, zinc, all those good little things that go into the early stages of production. And it's a price index, so obviously as the price of those things move, this index is going to likewise move. And I mentioned there the reason that this chart stands out is fairly obvious. So that blue line, by the way, is the 200-day moving average. Why use a 200-day moving average? Well, it's a fairly good rough approximation of what the trend is. If the price is above that, it's in an uptrend. If it's below it, it's in a downtrend, most likely. Unless, of course, we're in a sideways moving market like this period here, where it didn't really point you in either direction. But here we've had a fairly convincing move below that 200-day moving average. And when you think about commodity prices, there's two major things that drive them, of course, demand and supply. Supply tends to be a little bit slower moving, particularly at an aggregate level. Certainly when you're talking about an index like this. Because, why is that? Well, because if you want to increase supply, usually, for plants, for agricultural stuff, you have to plant the things, and that takes time. For materials like zinc, you have to build mines, and you have to build infrastructure and to get the stuff out of the ground and off the market. And those investment cycles can take a very long time to run their course. Demand, on the other hand, moves much more quickly, more in line with the business cycle. And so that's why, you can look at indexes like this and say, oh yeah, if this is moving down at a very fast pace, probably means that demand is falling. And if it's moving up at a fast pace, probably means demand's increasing. So you look at the latest movement there and you can sort of draw a conclusion that maybe demand is not looking as hot as we think. Certainly for places like China, where we know that conditions have been a bit more challenging there. Previous tightening and the trade war definitely weighing on the outlook there, and when your economy is more of a production-led economy, and you see this happening here, it's probably easy to tie two and two together there. So it's definitely one to be wary of. And certainly one that I'm thinking about, but this can turn around fairly quickly as well when you're thinking about demand, and particularly when it comes to China, if they undertake more forceful stimulus, which is not actually something that we've seen yet. We're keeping an eye out for it, but if they undertake more forceful stimulus, then you'd expect to see it turn around. And it's also a good way in that particular example of seeing whether actually what they're talking about in terms of doing stimulus is congruent with what we're seeing in terms of the reaction, because you'd expect that if they undertake material stimulus, that you'd see a turnaround in indicators like this. So definitely one to keep an eye on. And an easy way to keep an eye on, just a shameless plug here, is to take a look at the Global Cross Asset Market Monitor. That's a weekly chart pack that we put out on Monday mornings, and that covers basically all the major markets of the world, all the major asset classes. Really good way of just getting on top of what's going on and detecting early trend changes like the one that we're looking at right now. Get in touch if you want to have a look at that. Number 5, last one. Last but certainly not least, Japanese profit margins. So this is something that I don't think a lot of people are talking about. And profit margins are pretty self-explanatory. It's profits divided by sales. How much of the sales are you converting to the bottom line? And for Japan, it's been fairly stagnant for quite a number of years. Even when economic conditions were booming in the mid-2000s, it was still lagging significantly behind America, but now it seems to be catching up. And why would it be doing this? Well, there is that cyclical aspect. You can never forget the cycle. I think a lot of people tend to get confused. They see a cyclical move and then they start to try and tell some sort of structural story, tell you about a new paradigm and all these changes that are underway. So you have to be careful that you don't get confused by cyclical strength, and we're definitely seeing cyclical strength there. All the economic indicators that we look at on Japan from a cyclical standpoint look very strong indeed. But there's also been structural stories there, and with the caveat that I said. But Abenomics, one of the initiatives under Abenomics has been a push to improve corporate governance. Japan has been pretty notorious for bad corporate governance. You have all these cross-shareholdings, and a lot of the time companies exist more as a means of creating jobs, or making the upper management fairly comfortable, but not so much the shareholders. So there has been a shift there in policies and governance, just trying to push a shift in culture and guidelines for listing, etc. And I think this is probably the clearest indication that we're actually starting to see some movement on there, because oftentimes you got to be skeptical of these sort of things, because talk is very, very cheap. But then when you see them taking action like this, and the things that we'd like to see more of is more dividends, more cash going to shareholders, more focus on doing what's right for the shareholder, right, rather than what's right for management. And that we're starting to see the early signs of this, helped of course by a cyclical upturn, has really started to change the game for the fundamentals in Japan. So that's definitely a market that we've been looking at very closely. It's one that we've been overweight, or recommending to be overweight for probably much of this year, and I think this is going to start to work out really well. And it's the value case is very, very much there, and it's hard to find a market globally where the value case and the fundamental case is both improving. I think people are still a bit skeptical in Japan because of because of the big monetary experiment that they're playing, the large amount of government debt, and just the demographics. But demographics matter in the long run. But when you're talking about medium-term cycles, again, that's that structure versus cycle. You got to think about that. For active asset allocators, you got to think more about the cycle and be mindful of the structural trend that that will help accentuate and determine the cycle to some extent. But you got to keep focused on that medium term. And we'll leave it there. If you want to receive these top 5 charts of the week in your email box, just go ahead and go to www.topdowncharts.com. There's an email sign up there and you can receive it. So thanks for tuning in, and be sure to subscribe to the channel so you don't miss out any future updates.